A single number rarely tells the whole story, especially in banking. RCBC's first quarter of 2026 offers a lesson in how higher interest rates can be both a gift and a challenge, shaping the fortunes and trials of even the most seasoned lenders. On one hand, the climate was favorable. As rates climbed, RCBC's lending engine accelerated. Net interest income surged by nearly 25%, reaching 15.4 billion pesos. Net profit climbed to 2.7 billion pesos, an impressive 11.6% year-on-year growth. Loan activity expanded, yields rose, and a sharp drop in funding costs created the kind of margin expansion bankers dream about. 90% of the bank's operating income now stems from this core business, a sign of strong fundamentals rather than fleeting windfalls. Yet the same force that swelled margins dealt a silent blow elsewhere. Rising rates punished the value of RCBC's existing bond holdings. Because many of these debt securities are marked at fair value through other comprehensive income, losses didn't show up in net profit, but they sliced total comprehensive income down to just 223 million pesos. For every gain in the interest margin, there was a mark-to-market loss, a reminder that accounting can split the picture, showing strength on one side and sensitivity on the other. The shape of deposits added another layer of complexity. Clients chasing higher returns shifted funds into time deposits, which are more costly for the bank. While overall deposits grew, the mix became more expensive. Over time, this trend could squeeze the very margins that higher rates have just improved. Credit costs rose as well. RCBC's provisioning for potential loan losses increased by over 60%, counterbalancing much of the benefit from stronger core earnings. Non-interest income, meanwhile, suffered from weaker trading and foreign exchange results. Still, resilience showed through. The bank maintained steady asset quality and disciplined lending practices. It returned more to shareholders in dividends, and after quarter end, raised new funds with a well-timed bond issue. So, what's the takeaway for investors and analysts? RCBC's quarter is a case study in the paradox of rates. Higher yields propel profits and simultaneously stress the balance sheet. If rates keep climbing, margins could remain firm, but pressure will build from funding costs and further marks on securities. If rates retreat, losses may ease, but so could earnings power. In this delicate balance, RCBC has demonstrated skill. The results speak not only to the bank's adaptability, but also to the complex push and pull that now define modern banking. As interest rates give with one hand and take with the other, successful lenders are those who manage both stories at once.